Welcome to The Explainer. Today, we're going to tackle a really big question in finance. Why do interest rates for different periods of time look the way they do? It sounds a little academic, I know, but getting this is absolutely key to understanding where the economy might be heading.
So, what if I told you there's one single chart that some of the smartest people in the world look at to predict the future of the economy? We're talking about the yield curve. It's basically just the line that shows interest rates over time, and it is our key to unlocking this whole mystery.
You see, the shape of this curve, whether it's sloping up, pointing down, or just kind of flat, it tells a story about what investors think is coming. And there are four major theories that try to explain it all. We're going to break them down one by one.
Okay, let's start with the foundation, the simplest explanation out there. This first theory asks us to imagine a world of pure logic and perfect information, a world where every single decision is perfectly rational.
So what does that actually mean? Well, simply put, this theory says that a long-term interest rate, say for a 10-year bond, is just the average of the current short-term rate and all the future short-term rates the market expects over those next 10 years. It's all very neat and tight.
Now, this has some pretty wild implications, right? It means an investor is totally indifferent between buying one 5-year bond or buying 5 one-year bonds, one after another. The expected return is identical. In this world, the market is a perfectly rational machine, and you get no extra reward for taking on the risk of holding a bond for longer. So how do you remember this one? Easy. The pure expectations theory is all about what you expect. Think of it like booking a trip. The price of a really long journey is just the average cost of all the shorter connecting flights you'd expect to take to get there.
Okay, that pure expectations theory gives us a nice, clean baseline. But let's be real, it ignores a huge part of being human. We just don't like risk. So now we're going to add a layer of reality into the mix.
And this next theory does exactly that. It builds right on top of the first one, but with that dose of reality. It acknowledges that locking your money away for a long time, well, that's risky. What if interest rates shoot up and your bond is suddenly worth less? To convince you to take that risk, they have to pay you a little extra, and that extra payment is the liquidity premium.
And this is a huge deal because it explains why, most of the time, the yield curve slopes upwards. That upward tilt isn't just because we think rates will go up, it's also the cost of certainty. It's the premium investors demand for locking their cash away for longer. The memory trick here? Super simple. Investors prefer liquidity. They like having easy access to their cash. So to give that up, they demand a premium. Sticking with our flight analogy, this is like paying more for a direct long-haul flight. Why? To avoid the risk and the hassle of having to rebook a bunch of shorter flights later on.
All right, so the first two theories assume investors can just swap between long and short-term bonds no problem. But what if they can't? Or what if they just won't? Our next theory is a pretty radical departure from that idea.
Yeah, this one is a total 180 from what we've been talking about. It suggests the market for 1-year bonds and the market for 30-year bonds might as well be on different planets. Each one is its own little world with its own customers and its own supply and demand that sets the price, or in this case, the yield.
And you know what? This is actually driven by very real-world stuff. Think about it. A giant pension fund has to pay out benefits in 30 years. It needs to buy long-term bonds. A bank, on the other hand, might need short-term assets to match its deposits. They're not even shopping in the same aisle.
And we see this happen all the time. This quote about so-called fallen angel bonds is a perfect example. When a bond gets downgraded, a ton of investment funds are suddenly barred by their own rules from holding it, so they're all forced to sell at the same time. Bam! You get a flood of supply in that one specific segment, prices crash, and you can see market segmentation in action right there.
So, the trick for this one is to think of separate, segmented buckets of money. You've got your short-term bucket, your long-term bucket, and they don't really mix. In our flight analogy, it's like saying the market for short business flights is totally different from the market for long family vacation flights. Different customers, different demands, different prices.
Okay, so we've looked at two extremes, right? On one hand, everything's a perfect substitute. On the other, nothing is. And as is often the case, the truth is probably floating somewhere in the middle. And that brings us to our fourth and final theory.
This theory is so clever because it basically takes the best bits from the other ideas and mashes them together. It says, look, investors have their preferences, their preferred habitat, but they're not totally rigid about it. That pension fund might prefer 30-year bonds, but hey, if 10-year bonds are offering an incredible deal, they can be tempted to move out of their comfort zone.
And this is why so many people think this is the most realistic theory of them all. It's flexible. It says the yield curve is shaped by both what we expect rates to do in the future and whatever premiums are needed to coax investors out of their preferred spots. It helps explain why the yield curve can be upward sloping, downward sloping, flat, or even humped in the middle.
So for our final memory trick, just think that investors have a preferred home or habitat, but they can be tempted away if the offer is good enough. Back to our flight analogy one last time. Business travelers prefer short flights, and vacationers prefer long ones. But a massive, once-in-a-lifetime sale on long-haul tickets? Yeah, some of those business folks might just be convinced to take that long-overdue vacation.
Okay, that was a whirlwind tour, I know. So let's put it all together now, side by side, so you can really see how these theories stack up against each other. This right here is the big takeaway.
You can really see the journey we took in this table. We started in that perfect world of pure expectations, where bonds are perfect substitutes. Then we added a dose of reality with the liquidity premium. Then we swung to the complete opposite extreme with segmented markets, no substitutes at all. And finally, we landed on the preferred habitat theory, that realistic middle ground where bonds are imperfect substitutes and the curve is shaped by, well, a bit of everything.
So why does all this matter? Because at the end of the day, no single theory is the right one. The actual yield curve we see every day is a messy, beautiful combination of all four of these ideas. It's part cold logic, part human fear, and part the simple, practical needs of the financial world.
By understanding these building blocks, you can now look at the yield curve not just as a line on a chart, but as a dynamic story being told by millions of investors, a story about our collective economic future. So the question to leave you with is, what story is it telling you today?